Hi, good morning, everyone. I think we'll begin. First and foremost, Happy New Year, everyone. And if you've been guided by Llama Research, I think it's turned out to be a decent entry into the new year. We've been able to kind of pull through quite a lot of weight given the recent market corrections as well. The portfolios have kind of done well. Before I delve into the presentation, I just want to confirm. Am I audible? Right?
Yes, Karan.
Yeah. Okay. Cool. Thank you. Uh, and I'll just start sharing my screen. Before we begin, just a standard disclaimer: investments in security markets are subject to market risk. Um, Anything that we show here, any calls, any company's example that we discuss here, are just illustrative purposes. There are no recommendations on any of them. Uh, we calling this investment outlook, the annual outlook, as the 2.5 steps. Why 2.5 steps? Because we believe that the US, there is a big kind of cycle divergence between how the US is placed and how India is placed. We feel in a business cycle perspective, the US is kind of 2 steps ahead, while India is half a step behind. Now, generally, I know all of us are kind of slightly worried about where the equity markets are headed. But generally, a broad-based correction kind of happens when everyone is in sync, in at least in terms of market cycles. So if we are half a step behind and if US is 2 steps ahead, we need to cover this 2.5 steps. How fast do we want to cover it? Again, is anybody's guess, but we should cover at least these 2.5 steps for everyone to come into sync before we start looking at any kind of meaningful correction as such in the markets. So hence the entire outlook is called 2.5 steps. This outlook is divided into 3 chapters. Chapter 1 is basically uh, where are we? Where are we in terms of business cycle? It's called the reckoning. Why are we here? That's the entire basis of um, the entire thesis, the entire investment thesis, the why of the do's and don'ts of investment world. Chapter 2 is called the hunting ground, which is if we are here, then where do we go? And the third portion is basically called the execution. Once we know where we are, then how do we translate basically what we've learned into portfolio actions? So very quickly, what we've done is basically, again, here the idea is that we've given out a letter admitting that uh, while across the last year we gave out 10 major calls, 7 of them turned out to be decent, but it is very important that kind of we recognize that there are 3 misses that we've done. We went overweight on energy too early. Somewhere around mid-year last year, we gave a call that we are long on energy. The thesis for that was also simple, that given that we are coming up with data centers, given that there is a big energy transition taking place, we believe that energy transition cannot happen without oil being meaningfully expensive. We continue to hold that thought process. We continue to be long on oil, while oil and gas, both we are long on. While gas has meaningfully recovered, it is a profitable trade for us. Oil is still a sideways trade, and we continue to hold that. The second one that we missed was basically the Mag 7 post July rally. This is after tariff decision. I think we were the only one who called during the tariffs that we are looking at small cap US stocks. They gave very decent returns up till July. July is when there was a lot of delay around trade talks. There was no trade deal with China. It was being pushed. The can was being pushed down the road, and what we believed was basically without the clarity, the markets would kind of lose the momentum that is there. And the third is basically the extent or the kind of we underestimated basically how fragile small cap market was in the September rally. While our positioning was always into quality, and people who were invested with us have seen their portfolio meaningfully rise between this period, the broad-based market, we kind of undercaptured how much fragile it was. So it is very important for us to at least why I don't think anyone starts with their kind of where they missed out. Everyone would kind of come and chest thump that what they got right. But it's very important to be humble and to be understand to basically keep it as a learning that these are the stuff that we've not gotten right and what we can learn out of it, because all the while the markets keep throwing us these curveballs which we have to learn from. And the idea is simple, that any conviction without kind of humility only ends up into being a gambling, and that's what we don't want to do. Now, what this report will kind of do is obviously saying that where we are wrong. We will also tell you that how to position yourself for the US-India cycle divergence, and we'll give you probabilistic scenarios. We'll not give you short scenarios. I wish we had a crystal ball. We don't. We want to create things from whatever probable decisions that we can make. This report won't guarantee you for sure 10 sure stocks that would create FOMO in you, which is not our intention as such. So this is the investment desk. I'll just give a shout out to Anshuman and Odisha, who worked very hard on the report and continue to work hard with me here on the investment team. And this is what our conviction is for 2026. The three things that we are kind of looking at is, one, the business cycle across the world is fragmenting. The US is, again, as I said, it's in late cycle. The labor market there is cracking. The margins are being compressed, and there is a certain slowdown risk that one has to be aware about. While India is obviously in a mid cycle, that's the 2.5 step difference that we talk about. The credit cycle is turning upwards, which is a very positive thing. Capital capacity utilization is increasing. The balance sheets of banks and companies are probably the cleanest that we've seen across in a decade. This is where India is placed. So what's the opportunity here? The opportunity is basically a 9 to 18 months arbitrage window, wherein how we are placing ourselves as being kind of underweight in US and being overweight on the Eastern economies. This 2.5 steps basically gives an asymmetric opportunity for us to kind of bring in a lot of alpha across the board. The second thing that we kind of look at is disinflation and a very sturdy growth in India. The inflation here in India has collapsed to 0.7%, which is the headline number. While the core remains sticky, the core is around 4.2%. The CPI at 0.7% tells us that it is there's no kind of the supply is kind of there's a lot of supply in the market. The demand hasn't fallen off. So it's driven by food deflation rather than a loss of demand, and there is kind of quite a good growth as well, which we are seeing in terms of GDP numbers, which are around the best in the world. This creates a massive policy buffer for the RBI. So basically, what is the real rate? Real rate. So what you kind of see is a nominal interest rate, which is 5.25%, which is your headline numbers. A lot of media houses tell you that the repo rate is at around 5.25%. When you subtract the inflation out of that gives you the real policy rate. So the real policy rate comes out to be at 4.5%. 4.5%, 4.55% is basically a very large policy buffer that RBI has. They can meaningfully cut rates going into the year. They already have cut rates from 650 last year to 525, I think, this year, like by the end of this year. They've meaningfully cut rates. Still, there has been no kind of inflation that has kicked in. So the 4.55% of real rates give a lot of policy rate buffer to RBI to be meaningfully again cut rates. What we think the RBI has at least a minimum of 25 to 50 basis points of ammunition with them to cut rates, while Fed trades out there are starting to see inflation pick up for them. They are being forced to cut rates because their employment or unemployment rate is high. Their employment market is kind of shaky at the moment. So they are cutting rates for the wrong reasons. We here in India are trying to cut rates to get our inflation back up, because a country growing at 8.2% and having inflation of 0.7% is kind of an extremely good scenario that one bank can find themselves into. The last pillar here is basically the valuation premium. A lot of people are, across the board are saying that India is expensive. So at 22.9 times earnings, is India expensive? Definitely it is expensive. But is it a bubble? We don't think so. It is the difference that between we are obviously trading at a 75% premium to other emerging markets, but given the growth rate that we are growing at, I think the valuation kind of is justified at the moment. Obviously, there are risks to it. Why is the premium justified? When I say, because the return on equity has been the best across the last decade. We have almost a 16% return on equity. The leverage has fallen. Obviously, the balance sheets of the companies, as I said previously, has never been better. The policy credibility is also strong. We've seen both fiscal and monetary policy in sync. Both RBI and the government are in sync in terms of spurring consumption and growth in the economy. So if we separate the valuation from the positioning, we we don't need India to keep getting cheaper to kind of make money. We can always make money at around 22.9 or 23 times earnings as well. Obviously, that is the fun part. That is the good part. There are some things that keeps the investment team here at LLama Research up at night. First and foremost is the US labor market. The US labor market obviously has developed a lot of cracks over the last 3-4 months in particular. When we saw this in July, we said that, and there were questions around whether US is heading into a recession. We said, if people remember back then, we said that at least we don't see a recession coming at least in 2025. Why were we able to say that so confidently at that point of time? Because the labor market was still strong. And there's a favorite indicator that we use here at LLama Research, which is called the SAM rule. SAM rule is basically if you want to go behind the math of a SAM rule, it is basically the difference in the 3-month unemployment rate when compared to the 12-month unemployment rate. So you can very simply kind of go to Google and just search for SAM. It would give you a SAM recession indicator. So this is the real-time indicator that kind of one can use. You can always look at the SAM rule here. So when we looked at it in kind of July, the SAM basically at that point of time was very benign at around 27.27. Now what does 27 and 0.43 here mean? So right now it is at 0.43. How to read this is basically, if your SAM indicator is greater than 0.5, your economy is in a recession. Not yesterday, not tomorrow. It is at that moment in recession. We're very close to 0.5 now. It is at 0.43. So that means that the recession risk in US have obviously gone up. So that's something that kind of keeps us worried. The last time that we checked, it was around 0.2, 0.25. So we could meaningfully tell you with certainty that at least recession wasn't coming in 2025. We can't say the same in 2026. Given that Fed is being pushed to a corner in a way that, they push to a corner and are cutting from a position kind of which is not of strength, a position of weakness, because they are cutting because the labor market is shaky. We feel that this could spur another inflation second wave, which would then curb the kind of the power that Fed has to cut rates meaningfully. So these are the two global ones that the US centric ones that we kind of are worried about. Obviously, the third one is what we said. While we feel that the valuation that India kind of has at this point of time is justified, there can be a transmission that can take place in India as well. This transmission cycle, we've noted down this transmission cycle. If the document that we shared mid-month last month, which was the macro dynamics, we've kind of given you the transmission chain, which begins from if there is a sell-off in the global, if there is a global risk-off scenario. We believe that while FIIs are selling in India, they would meaningfully increase their sales in India, which would eventually lead a lot of pressure to the rupee, which can lead to compressions in the valuations, which are at around 23 times right now. That can meaningfully correct. So that's another risk that we are heading into. And the fourth risk is obviously that a lot of this has been a lot of these rallies, apart from Fed driving a lot of money into the market. The Chinese bank also, the PBOC, has been meaningfully increasing liquidity into the banking system and into the global system. So if their stimulus kind of starts disappointing in a way, then we would see a liquidity dry up, along with other liquidity parameters like the yen carry trade and others that can kind of go wrong. So that's those are the kind of risks that we are looking at here at Llama Research. We also have so based on this framework, what we've kind of done is that we've on our platform at llamaresearch.in, we provided a portfolio analyzer now. So you can come in and it just takes less than 2 minutes to analyze your portfolio now. So you can just load it is an automatic connection with your broker account. So your entire portfolio can be kind of put into and be analyzed in less than 2 minutes. This analysis tells you how your plays basically based on your risk profile. How are you based on your large cap, small cap, mid caps, and on basically on the entire business cycle? How concentrated are you? Whether you are in the right sectors or not. So I would encourage everyone to kind of try this out as well. Very quickly, what are our hits and misses of 2025? The hits were, as I said, 7 out of 10. If you've seen us and read what we kind of come out with, we were very early in the precious metal cycle. We were ahead before I think LinkedIn and Twitter started telling you about silver being up around 100% or not. So this translation has given us a return of around 100% on gold, 105% on gold, and 170% on silver. If you hold our portfolios, you know how kind of placed we are on metals. They have given 30% returns across the year. The idea was very simple, that again, given that we are meaningfully moving towards a green energy revolution, we could foresee that there would be supply shortages in metals. Given where we are right now, we still feel that the net neutral or the carbon neutral, the net zero target of Paris 2050 is unachievable. Yeah, metals will continue to be kind of in shortages. There is a particular chart that we'll come to in this particular session as well, that we've kind of shown a number of times. We'll show that again just as a reminder. We also placed ourselves in industrials and infrastructure, which gave 28% returns. As I told you, that the day tariff was announced, we thought that this would meaningfully kind of change the way people were looking at small caps in US. It gave a brilliant opportunity for them to start building their kind of Atmanirbhar US or something. So we kind of started looking at US small caps. That entry gave us 40%. Obviously, in the middle, we missed out on the Max 7 rally. We were not interested in Max 7 from the beginning because their valuation never made sense to us. The small caps, on the other hand, were kind of valuation wise, they were very attractive. The opportunity presented at that point of time was amazing, and we kind of continued doing that from the beginning of the year. And if you hold our portfolio, you would see that we don't have any IT stock. We continue to remain underweight despite a lot of people saying that valuations look attractive in this particular stage. We've avoided that sector, and by avoiding that sector, we were able to avoid minus 13%. Basically, the sector kind of gave. At the beginning of the year, again, we went long China. We realized that the power is shifting towards east, so that has given us 40%. Also, another contrarian call that we kind of took, that balance sheets were clean across India, but a lot of people said that PSU banks did not look attractive for us. The valuations made immense sense to get into PSU banks. So that call has given us 38%. The three wrong, the misses, I've acknowledged them right away, straight away. The energy timing was probably too early. We continue to hold them. While natural gas for us has become profitable trade, oil remains kind of sideways. We're still holding with another 6 to 9 months view, or probably we'll keep holding across 2026. The Max 7 rally that we missed between July to August, we missed out 15-20% on Max 7. We still don't hold Max 7, to be honest. We hold some bit of it in terms of ahead of Max 7. Things like, going forward, things like Micron, Arista Network, we continue to kind of hold those. But for us, absolutely the Max 7 itself does not make kind of sense to us. The small cap correction, the severity of the small cap correction, while a lot of our clients were kind enough to tell us that probably, this market does not look right. We thought that it would not create a broad-based destruction. The portfolios of ours kind of continue to do well, so we were insulated in a way, but the correction has been very meaningful as such. So what we can learn from all these mistakes is basically that while our direction could be right, our timing can be better. Obviously, you must have heard that it is very impossible to time the market. We try to do it as good as possible, but that sometimes leads to being that maybe energy is the right place to be. We just a bit early, maybe it has led to some bit of underperformance. We missed out at other places, but we could have used stage entries for that scenario. So that's kind of a learning that we have. The second learning obviously is that quality protects you in downturns. So whenever there is a major downturn, if you are in a quality portfolio, the way that we've done at least in small cap for us, you can avoid a larger kind of broader market fall. The contrarian plus the cycle kind of, if all of our calls were never popular on day one. There were many backs and forths with clients, with prospects that this call is not kind of, for the lack of better word, not sexy enough. These are boring calls. So they never made sense on the first day. It was a very contrarian bet that we took. But if you are right on the cycle, the contrarian bets do work. So things like PSU Bank, China, US small cap, metals, industrials, everything validated that any contrarian call with cycle continues to do well. The fourth learning that we had was commodities needs patience. That commodities, the cycles turn at the least possible time possible, like whenever you expect. The least expected time is when the cycle kind of turns. Across, I think 2025, there were so many opportunities that metals could have gone up. You had a meaningful fall in the dollar from 110 to 100, which was like a 10-12% fall in dollar. Metals refused to move. It was when dollar went from $98 to almost 99.5 that sideways movement is when metal started their run up. So commodities needs patience. While it on everything, every star might align, it still requires that extra bit of it tests you out that extra bit. And the last learning is basically, if there is a narrative, if there is a story behind it, if there is a strong thesis behind it, then valuations kind of do not matter. This comes from our Mag 7 miss, basically. While Mag 7 continue to be extremely overvalued, the narrative here is basically we are fighting the Fed, which has never worked for a number of investors. So having said that, this is our 2026 thesis in one glance. If we look at different indicators across the three major economies of US, India, and China, I think this is what we kind of call our traffic lights. This gives us, whenever in trouble, we just come back to this and kind of update it in a way to give us a lot of meaningful data in one shot. What we've realized when we look at this is that 2026 will actually reward a lot of cycle awareness over stock picking, a stage conviction over a lump sum bet, and quality over momentum. We've said that India is in mid cycle and US is in late cycle, while China continues to remain an export led. Still, we don't see a number of signals telling us that their domestic consumption is up. So that's where we call it two speeds. While exports are kind of doing fine, their domestic consumption is not picking up meaningfully, and we'll continue to monitor that as we go forward. With that, I think the growth momentum, the best is in India. The labor market, obviously, US is in deep trouble. India continues to do well. While we had a shocker, the Naukri job index number around October, we were meaningfully able to come back from that, and we continue to do that. The major thing here in India is the credit cycle. The credit cycle is kind of turning after days and months of pain. I think we've been calling out credit cycle for a long period of time that it's just not going up. It started to turn around, which is thankfully, which is kind of good for us. Corporate health are well. Government balance sheet is pretty decent when compared across the world. I think US and China, the amount of debt the government has taken, India can kind of do a lot of chest thumping there, that we've managed to have a good government balance sheet. Inflation across India and China, we the two economies that kind of have very benign inflation, while US continues to struggle with inflation around 2.7 and rising upwards. Policy support, this is where there's a lot of debate within the team as such. We feel that the policy support is doing well, but we still would want more from both the central bank and the government, given that given that we have all the stars aligned in terms of GDP growth, inflation being benign, and credit cycle turning. There is a lot more that we can do to grow really meaningfully. This is an opportunity of around 9 to 18 months that we believe that if there is a meaningful policy support, then India can outshine a lot many other its peers in the world. While in US, the despite inflation coming back, or may come back, picking up rather. That's the easier way to say that. There's just a lot of policy support. If that similar kind of policy support in India we can see, then we can meaningfully grow as well. Valuation wise, obviously US is deeply overvalued. Like it's like 28 times NASDAQ, 22, 23 times S&P. That's kind of quite high valuation. We are on similar breadth, but we are growing majorly fast than US. So that is why we've still not given it a green light. We are worried about valuation compression, as we said, in the risk. China, on the other hand, kind of at 11, 12 times, 13 times, continues to look attractive as well. Exports, both India and China, are doing well. So with that, we are underweight US, we are overweight India, and we are selective on China. At least we've started picking up on export themes, but we're still waiting for the signal on the consumption basis. The opportunity the most easiest opportunity that we can tell you here is that if you remember 2016-17, and this is a very interesting time, that there's a particular chart that will be thrown around in 2026 many times, which is called the Benner cycle. That is a brown chart that you might just see with a lot of cycles that we will come out, across media, across different news channels, across different social media channels. That looks something like this. Sorry. So if we kind of just look at this is the kind of chart that you will kind of seeing a number of times. If you actually look at 2000, this is divided into three parts. The A is when panics have occurred. If the B is when the years of good times. These are the times that Benner cycle tells you to take out kind of money from the market. And C is the year of hard times, when you should put money into the market. If you look at B, and if you look at 2016, it was a year of good times. It was high prices, and what Benner cycle tells you that you should sell stocks in terms of these are good times to sell stocks. If you had gone and ended up selling NASDAQ in 2016, looking at this particular cycle, I think that price never came back again. So these kind of cycles may go wrong across time. So what we feel is that probably India is where US was in 2016-17. This is meaningfully the time that a lot of these cycles will tell you that we should take out money. But we are post a cleanup. We are post a lot of macro good signals out there. What we feel is that US is probably in 2018-19. They are open to a number of shocks. They are in the late cycle, and the risk obviously in India is that valuation wise, it would have been amazing if we would have been at around 18-19 times. Then the weights, I think, probably would be it would have been absolutely been a no-brainer. At 23 times, there is a risk of that valuation being compressed. Our positioning right now is 87% in equities, and in India we have 72%, China around 12%, and US around 2%. We are preferring quality over momentum. We are overweight financials, energy, infra, and metal. and we are underweight ITs, and there are those export themes in autos. As we continue to tell you, we love the domestic theme in autos, but we're still waiting for changes in the export themes in autos. This is the compass across 2026. Always, I think quality is the one that needs to be. This is the period where it won't be a broad-based rally, is what we feel. It will lot will depend on actually how what kind of stocks that we end up choosing. This has been evident in the last 3 months itself. If you've been with us, that the portfolios that if you're right on the cycle terms, if you manage to pick up those quality stocks, then momentum is in your favor. If the quality has been poor and there has been momentum, then that has kind of fallen off as well. There have been so many stocks that have gone up around. There have been so many companies that have gone up around 15% and have fallen back another 15% to come back where they were. Our conviction is led in China and India. As we said, both of them hold meaningful weight in our portfolio. While there is a cycle divergence, there's a 2.5 step cycle divergence between US and India. But will this cycle divergence, as humans, what we lack is a lot of patience. We don't wait kind of for divergence to correct itself. So will this cycle divergence correct itself within the next 15 days? Obviously, it won't. It will take time for people to realize that there is a cycle divergence, and it will take time for that correction, that divergence to correct itself as well. So be patient around it. Be kind of this is the cycle in favor of India, but you will have to be patient around it. If you're looking at it from a 1 month perspective or a 1.5 month perspective, then it can lead to meaningful kind of pain as well. And we are selectivity in defensives as well. So we continue to be underweight IT. We continue to be neutral on private banks where we think it is fairly priced at. Some bit of auto as well, as we said. So I've been talking about this business cycle for quite a bit of time. So this is kind of the business cycle that number of countries are in. So this is the kind of difference that I'm telling you. This is the difference that we are talking about. While US, Australia, Korea, Mexico, so US majorly, that is our kind of benchmark that we compare ourselves. They are in this late cycle, moving towards the contraction cycle. While India, across the year, while it was here somewhere in the late cycle, has managed to push itself back into the mid cycle here. And this is the difference between US and India. So if you're looking at the US market for the last 6 to 8 months, that is because US has kind of slid off here, and the return that kind of US markets has given has pulled a lot of attraction towards the US market. Similarly, India is right now here moving towards the late cycle as well. So to move this particular region, I think that is where the opportunity lies. Why we think it is in mid cycle? Obviously, because the capacity utilization in India is increasing. It is around 77% right now and is rising. The credit growth cycle over the year-on-year change is around 11.5%. This is coming off from a cyclical low of 9%. So now we are at 11.5%. Manufacturing PMI also is at around the 55, 56. It's continued to stay above 55. At times we've seen it above 60 as well. Right now it turns out to be around 56, 57 times. 56, 57 is the number, sorry. It continues to be in expansion phase while US has moved, the manufacturing PMI in US has moved towards contraction, a number below 50. The policy rates, again, as I said, that the real rates are around 4.55. That is where RBI has the room to cut more rates from a position of strength, unlike the US Fed, which is cutting rates from a position of weakness. The earnings revision, while there are doubts that earnings might not pull through, we continue to be more vigilant around that. But the revisions we feel that could move towards the positive cycle because a lot of consumption can start taking place. The consumption, why we are positive on the consumption cycle as well, is because there were record sales in terms of autos and consumer discretionary over the festival season. That hasn't it hadn't meaningfully dropped off after that large sale as well. It has continued to remain as it was across the last year as however we grew the last year itself. It hasn't meaningfully dropped off after that massive sale in the Diwali time. there is obviously fragmenting leadership across the world. This is how kind of India, US, Europe, China, and Japan look like. The cycle stages are mentioned here. China at 11 times continues to be very attractive in terms of valuation. We would have loved India to be at 18, 19 times as well, but at 22 times also, it is expensive. There's no denying the fact, but that expensive premium valuation is kind of justified as well. So this is kind of how the markets are in terms of leaders. So the great rotation is what's happening. The capital is flowing east. So this is the exceptional the from the US exceptionalism to Asia emergence. From This is the 70-year capital migration happening right in front of us. While a number of things happen from 1950 to 2000, I think US led the globalization drive across the world. From 2000 onwards, obviously China has been building its own domestic capabilities. We feel that from 2020, India has started to build its own domestic capabilities as well. The Supported by a lot of policy schemes from both the government and the central bank as well. If you look at the manufacturing value add across India and China, that has meaningfully overtaken kind of US. A lot of that, again, caveat here, a lot of that comes from China at this point of time. Almost 90% or it comes from 80 to 90% comes from China. We have started to gain some bit of share, at least in that manufacturing value add. The growth in global GDP, if we look at that, there has been a major shift as well. So US's GDP percentage share dropped. Even Eurozone has dropped, while EMs like China and India have meaningfully risen in terms of our share in global GDP. So that's there. And yeah, so this is kind of the probability scenario that we feel for India. So we feel that across the year, around 43% times we feel that there is a 43% chance at least to be in the Goldilocks scenario. There's a 40% chance to move towards reflation, where inflation may come back, given that we are coming off from a low base. So we might see inflation pick up as well. There's a very less chance of being in stagflation and stagnation kind of place, where there is a large amount of inflation, but GDP has kind of meaningfully fallen off. So we continue to be positive that we'll be on the right hand side of this matrix, where GDP will continue to remain strong above 5 to 6%, while inflation is kind of a joker in the back kind of a thing, that it is a wild card. Given that the base is so small right now, 0.7% is kind of almost never heard of. That from there we could see high numbers, but remember that those high numbers are coming off from a low base. So whether we are in a Goldilocks or a reflation scenario, that would continue to depend on how we are doing in terms of credit cycle. So the credit cycle right now, as I said, is at around 11.5%, 11 to 12%. If we continue to remain in that credit cycle like 11 to 12%, then RBI has a room to cut around 25 to 50 basis points. We continue to be in a GDP of 7.7 to 8%, and CPI continues to remain low, below 5%, driven by supply overhangs. In that case, basically we think that Nifty can kind of give you around 12 to 18%. Mid caps can give you around 25 to 30%. The earnings can grow by 12 to 15%. Again, quality remaining intact. If we were to move to the reflation scenario, then credit has to go up, not from not remain at 11-12%, but grow up above 14%. There would be a big capex boom as well. That we will come to that as well. That the capex to depreciation ratio is at around 2 times right now. That is one of the best that we've seen in history. So capex boom will exceed the base case. There will be a consumption surge, given that we already have a tax cut and wages continue to grow. And then FIIs think that India is the place to be. So all of these drivers have to right now we are in the Goldilocks scenario. If you've been reading us, so we've said that India is already in the Goldilocks scenario. So if we have to move to the reflation scenario, then all of these have to take place for us to move to reflation scenario. In that case, obviously, your Nifty outcome becomes higher than your Goldilocks scenario. We'll have a larger outcome in terms of Nifty returns expectation and mid caps expectation. In that case, you could look at a number of cyclicals that could do well, and rupee to kind of meaningfully strengthen across the year as well. This is also possible given that we are not very positive on dollar. How can we move to stagflation? We can move to stagflation if your GDP growth falls off and inflation goes up. That can happen if there is a geopolitical or if oil goes up more than $100, but that happens because of a geopolitical reason and not because of supply reasons. If not because of demand reasons. If India and China both grow very fast, we are a developing economy. We will require more oil. If our demands pick up, then oil has the meaningful chance of going in higher in value. If that happens, and if we are above like this $90-$100 because of demand, then we won't move into stagflation. But if we move above $90 or $100 because there is a geopolitical issue, then there is a chance that we will face a lot of pressure, and there's a chance of moving into stagflation. If the food inflation kind of returns, we've been in the food deflation scenario. If that kind of returns, then there's a global then we kind of move into stagflation. If there is a recession across the world, a global recession, and there is a meaningful spillover that happens into India, then there is a chance of moving into stagflation. If rupee kind of goes above 95, 90.95, then there is the chance that we will face a lot of pressure in terms of exodus of FIIs moving out from India. In that case, the outcome in Nifty is negative between 5 to 10% minus returns. The margins will compress meaningfully, and in that case, defensives like staples, healthcare, others will start performing, and small caps will have a meaningful correction in terms of another minus 25%. The chances of moving into stagflation that we put is around 12%. Our framework tells us that there's a 12% chance that this can happen. There's a very benign chance that stagnation will happen, where both your inflation does not go up and your GDP kind of falls down. That is a case that we are not looking at this point of time. It is highly unlikely that we will ever move into stagnation across the year. So the major takeaway is right now that our frameworks tell us that we would continue to remain in Goldilocks with a meaningful chance that we will move towards reflation as well. This is kind of a correction that we've gotten, or a learning from that we've had on our framework from the 2025 positioning. While in 2025 positioning, we thought that inflation would make a meaningful comeback. It has not been able to do that. While core CPI remains sticky around 4.5%, our models did not account into the thing that food will kind of have a deflationary year, and we would end up the year at CPI at 0.7%. So last year we thought that there is a meaningful chance that reflation would come back. While that continues to hold on, we've gone and corrected our model saying that maybe there are cases that there are those offset cases where there is a lot of supply in terms of when demand doesn't fall off, but there is a lot of supply in terms of food as well. And we will continue to do that when we look at sectors as well. These are the foundation, the three pillars. I've kind of told this across our first chapter as well. There is disinflation without deflation. There is this credit cycle which is accelerating above 11%, and there is this policy convergence between the fiscal and the government and the central bank. Both their policies are kind of converging at this stage. So when disinflation kind of meets the credit acceleration, and all these three happen all together, like when disinflation without deflation comes into picture, when credit cycle acceleration takes place, and when policies converge, all three of them combined together, you don't get a bubble, you get a Goldilocks scenario, and that is where we are, and that is where we are moving across the year as well, and we'll continue to do that. And there are these structural advantages that are in India. I think all of us, if we're reading the news, you kind of know all of them as well. We have a demographic advantage. We're moving to a digitalized area. There's a policy reform that are taking place. The quality of earnings obviously are good, and there is a consumption drive that is coming through. What we believe that these pillars were kind of built in US between the 1950 to 1980s. These same pillars were built by China between 1990 to 2015. And these are the pillars that India is building right now. So probably we're not late. We're just kind of early into the India structural build out. We believe that India can continue to outperform a number of economies across the world, if given that you have patience to hold on to hold on to the advantages that we have developed over the last few years. So now that you know the why, we'll get to the where. This is where basically why we how and why we've reached here. Now, if we know the why, where should we look out for our returns as well? Before I move to the second chapter, which is the where, the hunting ground, I'll stop and take questions because yeah, I'm sure there would be quite a few.
Karan?
Sure, go ahead.
Yeah. There is a question from Navneet in a chat box.
Oh, sorry. Yeah, sure. Getting my money back in 15-20 years, isn't that premium too much? Yeah, sure. Navneet, so this is a question coming from the PE of Nifty. So basically, when we say 23 times PE, we have to look at where what does 23 PE mean? 23 PE means that you're getting your money back in 23 years. Today, whatever you put your money, it will take 23 years to kind of get that money back. Sure, if you're not getting your money back in the next 15-20 years, I think Navneet, are you there? Or? Yeah, Navneet is here. So if you're not getting your money back in 15-20 years, there is a big problem. The problem here is not the 15-20 PE of Nifty. The problem here is basically the higher valuations in the broader market, where there is not enough quality or not enough growth as well. Those kind of things that are you have got companies which are not giving you enough returns in terms of profits. So the bottom line is not that great. They've been able to pull through because they were burning a lot of cash. These most of them are these new age companies. Those trade at 1,000 times valuation or 500 times valuation, where you'll get your money back after 500 years. I don't think we should be waiting for the 500 years to get our money back as well. So the problem here is valuation in terms of the broader markets, where there is no quality, where there is no growth. If there is quality and growth, there are certain things that always trade at a premium. Things like your staples, etc. I don't think we've ever got names like Nestle or Colgate ever at 20. You don't expect them to come down to 20, 25 times earnings, or they continue to hold that premium as well. So looking at what at LLama Research, what we've kind of done is that we've looked at valuation not just from PE matrix, but from a very different angle. So when we kind of look at cement companies, we don't look at again PE of cement companies. We look at how much value we are putting for that ton capacity of that particular company. When we look at infrastructure companies or industrial companies, we look at what is their order book, what is their execution style. So there are a number of parameters across up and above the valuation parameters that helps us to build that quality premium. And given if they are not highly valued in terms of the number of, let's say if we're looking at a hospital company, we'll look at what is the occupancy rate and how many beds they have, and then what is the valuation that we kind of giving. So it's not just the top line number of, let's say, earnings, just the PE that we are looking at. We're looking at a number of different valuation parameters, and on those valuation parameters, if it's making sense along with quality and growth, then it makes a compelling case to get into. You're right that if you're not getting money back in 15-20 years, if you're getting money after 500 years, definitely not a place to go into. These are the sectors that we're kind of looking at for the year. So basically, how have we selected these sectors? We've selected these sectors basically based on where we are in the business cycle. We've discussed that we are in the middle of the business cycle. In this business cycle, what are the sectors that kind of do well? Out of that, we put up quality filters. A number of sectors have to pass our quality filters to kind of for us to start looking into them. And the last one that Nami just pointed out, what is the valuation that we are kind of paying for them? What are we paying for growth? Are we paying actually for growth, or are we just paying for hope? We don't want to pay for hope. We want to pay for growth. So based on that, this is our 2026 kind of sector positioning that we've kind of built on. So what we say is basically there are a few foundation builders. These are the ones that will require to fire for India to be able to achieve this 2.5-step cycle divergence. Along with that, obviously, once we produce a number of things, if people don't consume, then there is no point of producing, right? So along with that, consumption also has to take place. And these are the total of 8 sectors that we kind of are looking in India. Along with that, given that I said that US, the Max 7s are at extremely high valuation, we're looking at certain opportunities which are undervalued in terms of obviously valuation and have the potential to grow a lot. So while the growth is there, while the quality is there, the market has recognized AI and semiconductors as a larger theme, but I don't think they have recognized cybersecurity and biotechnology as a theme. What we're calling Indian foundation builders as are that given that the credit cycle is turning, we believe that financials could do well across the year. We believe industrials would do well. We are already placed into energy. We already placed into metals and mining. Like I don't think we've ever seen portfolios that are this large in metals and minings across. I've never placed my clients at least in so much in metals and minings. That's the amount that we've gone into, and we feel that there is a certain way that economies across the world are looking. They're looking a lot inwards. So there is a continuous chance that we would continue to do well with drillers as well. Drillers also, if you look from a valuation perspective, have meaningfully kind of gone are meaningfully undervalued at this stage. Similarly, there are select consumption themes, there are select specialty chemical themes, and there are fertilizer themes as well. So we'll continue. We'll just come to how we are kind of looking at into them. Looking into financials, I think we've done this a number of times. I think we've looked at the credit cycle revival. So we are at 11.5%. This is the credit cycle and how it is growing. While it was growing a lot in 2022, we feel that so it was growing a lot in 2022. There was a major drop off that happened in 23. This is how it is kind of coming back from the mid of the last year. This is the kind of thing that we kind of look at. So basically, there was a cyclical bottom here at around 9-10%, and then there is a kind of a pullback around now we are at 11.5%. This is coming because there is a capex to depreciation ratio at around 2 times. This is probably one of the best capex, and we'll come to this as well. We have it in one of the next slides that the amount of capex that is happening, the private capex that is happening in India, after a year or two's gap, it has overtaken government's capex. So there is private capex that is coming back, which is obviously a good thing. And there are a number of other parameters that kind of can lead to this credit cycle reviving and meaningfully sustaining itself. So RBI delivered this 125 basis points cut across in 2025. If they go ahead and cut another 25-50 basis points, that's the base case that we are running with. If that is there, then it will ease the funding cost for a number of industrials, number of SMEs and MSMEs, and that would kind of revive what we are looking at here in India. Even the loan book growth, at least in the PSU sector, has done very well. It is outpacing the private sector loan books, and given that NPAs have been like at a multi-decade low, we've never seen this clean balance sheets, at least in the public sector units. Given that they are so clean, can they become cleaner or can they become messier? Obviously, that's a choice that we'll have to take later in the year. But at this point of time, they are pretty much very clean for us to kind of look at them. So we already placed in PSU banks, as we said, that our PSU banks sector call itself gave you around 38% across the year, while Bank Nifty gave you 21%. So that's like a meaningfully 1600 to 1700, 1600, 1700, depending on when you played yourself into that cycle. That's the kind of alpha that this call has kind of given us. This is moving on to the industrial and infrastructure theme, and this is what I was talking about. That FY25 is like the time when private capex outperformed the government capex of 10.5 trillion. I think INR trillion in terms of. So 11 trillion was brought in by private capex, while 10.5 trillion was brought in by the government. So basically, that's a reversal of what we saw in FY24 when your credit cycle was kind of bottoming out, when it was falling down. There was no meaningful capex that was coming, or the capex was kind of lower than what the government was kind of pushing the metal. Now in 2025, what we've seen is that private players are now started to do a number of good projects to begin the growth of their particular companies. Given that is there, the expectation for FY26 is that this kind of thing continues. So from 11 trillion, we are expected to go to 12.3 trillion at least in private listed capex, and the government will also increase their capex in the next year as well. So given all of that, again, and we feel that industrial and infra kind of should lead ahead in terms of the capex boom that is there. While we are doing well in industrial and infra, there is a large segment which is the energy segment, where things like data center build up, semiconductor build up as well. This will be the one that will kind of be required across the next year. So while till now what has happened is that the capacity has kind of been built. So till now we were building capacity, we were kind of running short. We're still running short, but we were building capacity till now. Now the production starts taking place. So there are a number of ways to look at this. While from an energy perspective, what we are kind of looking at is from your transmission lines to your end energy supplier. So we're not completely into those ones which are supplying you those energies. So we're not from that generation perspective. We are looking at transmission lines. We are looking at companies that build you the energy infrastructure as such. So that is how we are placing ourselves into energy. We're not per se going for your generators of energy as such. So we're not placed there. Those we feel are meaningfully overvalued. But at least in terms of transmission of energy and the ones that are helping build the infrastructure for that energy theme, those are kind of not as overvalued as the ones that are kind of there. Also, looking at energy from the oil perspective, I think from the oil perspective, the refiners, and this is what we'll see in our drillers slide as well. This is a study that we've kind of done. So when you look at the profits right now for PSU refiners, they are kind of one of the better ones at this particular stage. So these refiners are basically the downstream players in an energy supply chain. While these have given returns, we're not looking at these downstream refiners at this stage. We're looking at upstream opportunities, which are basically the ones that drill and take out oil. So there is this, when you look at oil, you look at OMCs, which are your oil marketing companies, and then you look at producers of oil, which are the ones that drill and take out oil. So while we're not placed in OMCs right now, or we don't intend to place ourselves in OMCs, we intend to place ourselves in at least the ones that are kind of bringing out this oil, like refining and taking out oil. So that is where we are working on. We have absolutely no interest in OMCs at this point of time. So that's from the oil perspective. From energy and electricity perspective, we are looking at infrastructure builders and transmitters rather than energy generators. So both sides, we are kind of at the different side of a spectrum. Commodities, we continue to be overweight. Metals, we continue to be overweight. This is a chart I think that we've number of times that we've shown in MAP. We continue to hold this particular theory. When you look at the cycles from a commodity technology, like there's a 30-year cycle that takes place. 30 years, this is built up on US 10-year yields. So for 30 years, your yields kind of drop, then 30 years, your yields kind of go up. When another 30 years, your yields kind of fall, and another 30 years expected. We don't know that. But the idea here is that for the next 30 years, your yields will continue to go up. So whenever the yields continue to go up, the innovations that take place should be meaningful in nature. So that is what we are looking at, and all those meaningful innovations kind of end up requiring metals in some form of the other. So there is a supply demand gap that is there. So and there is not enough supply in the market of metals as much as demand is there. We recognized this supply demand gap way back, like 1.5 years back, when people weren't even looking at it. We still feel that the net zero of Paris Accord 2050 is not possible. So, given that the amount of metals and the mining capacity that we've got right now, we're not moving towards net zero kind of thing. But still, we will continue as an entire human race. We kind of continue to try to reach that 2050 net zero target. But given that the capacity that we have got right now, I think it is very challenging to reach that 2050. So there's a massive place that we can make a lot of investments as such. That is what is required. Those working on the energy theme are kind of looking to try and reach that 2050 Paris Accord kind of thing. This green transition will obviously intensify the need for metals. So three to 5 times more metals are kind of required when you look at EV batteries and other panels, other grid build outs, all of that. So number of catalysts and number of things that are kind of driving this particular drive in metals. There is obviously when we are placed in commodities, and when you look at commodities are probably one of the most volatile things out there. It is more volatile than probably a small child on sugar. I think that is how volatile commodities can be. So if you stuck on an upswing on a particular metal, at this point of time, I would say don't be worried. It will take. There is a possibility that price will come if you are stuck on an upside in a particular metal. But it will take time. You'll have to be very patient around commodities. As I said, that commodities didn't go up. If you saw 2025, there were so many chances that you could have had this metal rally. Your US yields had fallen off from 5% to almost 4%. So there was a drop in 1% in US yields. Whenever US yields come down, your commodities get a upswing boost. Your dollar fell from 110 to $100 or $98. So there was a meaningful 10 to 15% correction in dollar. Both the times, and both of them happened kind of simultaneously as well. And during that time, metals refused to move. It was when actually, both the yield stabilized at around 4.2% and dollar stabilized between $98 to $100. That is when metal started moving up. So you'll have to be patient around commodities. You can't. It's very, very difficult to time a commodity swing. But right now there are a number of fundamental factors that are supporting the commodity cycle. So you'll have to be patient around it if you're kind of stuck on the top as such. Moving on to drillers and oil, that is where I said when talking about the energy slide, this is the kind of study that we've kind of done. So we looked at OMCs, we looked at drilling companies. These are the two things that we kind of looked at. And the idea here is that oil continues to meaningfully do well from demand from both India and China, and possibly the things don't look absolutely clean and crystal clear in the Middle East. So if there is an up move, so this is the kind of study that we kind of ended up doing. I'll pull this. So this is the study that we did on crude prices since 2000. So if the purple line is basically the crude price across the from 2000 up till 2025. So we had this large period of upswing in crude prices, where crude prices went from around $30 to almost $140. This is like your period one. Within that period one, there was the very meaningful. This is kind of a manic phase that is seen in a lot of metals these days. So this is the kind of manic phase that happened in oil between 2006 to 2008. So it kind of doubled or went a little more than double in almost a year and a half. There was a third period after that manic phase. Obviously, you had this cool down post the global financial crisis. Post the global financial crisis, again, between 2010, like 2009 to 2010, you saw around oil move from $40 to almost $120. So this is your period C. And then one period that we have looked around is that after almost at negative rates during the COVID crisis, oil moved from almost $20 on an average to $120. That's a 6x move in oil in 2 years time period. So when we did when we took these 4 periods, we saw that the correlation between oil marketing companies is absolutely very poor. So a number of times that we hear that oil starts going up, you end up buying companies like HPCL, BPCL. Those are your oil marketing companies. Their correlation with upswings in oil is pretty low. When you look at blend companies, there are a few companies that both drill and do OMC. They're right in the middle. They kind of do pretty okay. But the large amount of correlation, a higher correlation comes from your drilling companies, where when oil starts picking up, it is absolutely your oil drillers which continue to kind of do well. So when you look at a correlation perspective, the median correlation for drillers when oil does well is 0.32. When compared to OMCs, it is just 0.12. So when if oil were to start their run, we would prefer drillers over OMC. So that's what we feel, and that is why we at this point of time we are supporting, or we are making investments into drillers as such. So that's the study that we've kind of done, and that is why we are in drillers. Given the foundation builders are done, we feel that consumption also has to come through for these foundation builders to kind of do a lot more. So across the year, your repo rate was down, your credit cycle started turning. So now you can see that there is a major divergence coming here as well in terms of and this is a good divergence in terms of your repo rate falling down and your credit cycle turning up. This kind of placement kind of gives you a lot more boost to be in a particular sector. So consumption again, once your domestic demand, given your GST 2.0 and your savings in your pocket through budget 2025, if similar policies come out in 2026 as well, consumption should get a massive upswing. And once your foundation builders are done well, this is the one that kind of drives the whole story ahead. When consumption starts doing well, you start looking at specialty chemicals as well. Specialty chemicals across from 2000 till now, this is probably the time. This has been the most difficult time for specialty chemicals. This is probably a contrarian bet that we're taking on spec chems. The return on capital has never been so low on specialty chemicals from the start of the century. So given that we are on a cycle that I think it's turning up, for the first time across a particular year, this has stabilized in a way. So once this is kind of, if you kind of go back and look at this, whenever there has been a stabilized move, like you were kind of moving up and then you stabilized, so you started moving down. You were moving down and now you've stabilized. So maybe the cycle is turning on the upward side. But obviously, when cycles turn, they don't turn overnight. They take their time to turn up. So probably this is one where we'll have to be extremely patient around specialty chems. In specialty chems, the major thing that we are kind of looking at are dyes and pigments. We're looking at pharma intermediaries, and the last one is obviously has to be commodity chemicals. So when you look at the commodity cycle, if there are metals being smelted, bought out, they require certain kind of chemicals that aid the process. So those kind of chemicals also start to do well. So those have been our focus areas, at least in terms of specialty chemicals. Now, whenever we look at a commodity cycle, what we've realized is that when your metals do well, that generally brings home a lot more cash into a household. So when you actually look at copper, you would see that copper is also called a doctor of the economy. So when copper is doing well, generally the economy starts to do well. So when the economy starts to do well, that brings home a lot more cash. When a cash comes into an household, they end up consuming more, and whenever they consume more, food kind of becomes their primary go-to thing. So whenever we think of food, we can always look at fertilizers and ag chem. So that's how a cycle kind of runs. So you run from a metal cycle. So basically, if 2025 and the first half of 2026 would be when you talk about commodities, commodities are of two types: hard and soft. Hard are the ones which are basically metals, and the soft ones are basically your wheat, or the ones that you can kind of consume or wear. So basically wheat, all your corn, wheat, soybeans, or basically rubber, tea, uh, cotton. So all your seed kind of agriculture based ones are your soft commodities. So that's how a cycle runs. It runs from a hard commodity into a soft commodity. So when you think about soft commodity, the driver of soft commodity is basically fertilizer and chem. So that's where we kind of think the next uh, opportunity lies. Consumption cannot grow without I think fertilizers being into action. So that's and there are number of government initiatives here that are driving kind of this move into fertilizers and chem. So that the cycle kind of moves into that. Moving away from Indian sectors to two US sectors that look really good in terms of valuation. One is obviously cybersecurity. Here, a lot of consolidation is taking place. There is a lot of government push, given that AI. We're so bullish on AI theme, and everyone's running after your semiconductors and your AI theme. This is one that has been kind of neglected in a way. People not looked at cybersecurity till now, but a large, given that we've spent so much on AI, there is a possibility that you can actually attack another place with the use of AI. So you can attack at least on the internet. So cybersecurity is something that I think not a lot of people are paying attention on to. So this, given that there is a large, there are breaches that take place. There was one that happened at Microsoft, I think last year itself. So all these breaches, data breaches that happen because of cyber attacks, it is imperative that a number of more investments are done in particularly this sector. So I think US cybersecurity remains one sector that has been neglected, and the valuations make a lot of sense. Another place that valuations make a lot of sense is the US biotech space. Given that again all the money has gone into your AI and your semiconductor themes, there's meaningful kind of innovation happening in your biotech theme, where there is gene therapy, there are oncology drugs that are being made and discovered and being innovated into. This is kind of, this does not come from our quality filter as such. Quality wise, in the biotech sector in US, they still rely a lot on grants from the government. So there is major grants that come through. So the margins, it's very difficult to be right in terms of your innovation. So there is obviously, this is a sector that kind of is a difficult sector to get into. Which of your innovations will actually succeed it cannot be known from day one. There are a number of bets that you have to place. So if you're looking at the biotech sector anywhere in the world, if you're looking at the biotech sector, then you will have to place your bets kind of diversified into, because you don't know which innovation will kind of actually turn around and give you a fruitful result. So keeping a very diversified view on biotech, but this is the one that I think makes a lot of sense, given the valuations in this sector haven't yet meaningfully picked up. So again, this is a sector kind of we're looking at. So we done with the where. We'll quickly move to the how, and then take on questions. What we kind of doing is also the four scenarios that we talked about: the Goldilocks, reflation, stagflation, and stagnation. How we are splitting ourselves. Basically, what we've done is for every scenario we have a predefined, so that emotions don't run us. What we've done is we've predefined our asset allocations across different regions that are there. We've also defined what we'll call these particular these particular scenarios, when we will call it a reflation. So we've defined those. So what we are doing is that, given that we are in a stage of a cycle where the money is moving very fast and it is very easy to become emotional, what we've done is we've defined everything in the beginning and just build a framework out of it, and based on that framework we'll take our calls. So I know it might just sound redundant, because US Fed always comes and says that they are data dependent. We similarly, on the other hand, we also data dependent. So whenever we get data, we can name our probabilities in a way, like our probability scenarios in a way, and see where we are in the cycle. And where we know where we are in the cycle, we've already defined how we are going to place ourselves. So there is no emotional bias that comes across. We're working on data. Everything is systematic in a way. And there is reason to believe that, why, if we are taking an action, why we are taking an action. Not because we feel that this thing will double in the next 14 days, we're taking an action. We feel that this is the cycle that we are in, and that is why we are taking an action. This leads to how we are placed today. I think we've already gone through this. We're way overweight on India. We've also increased our weights in China. We continue to remain slight underweight in US and Japan, and we continue to remain. Frankly, we don't understand Europe at this point of time, given that they are absolutely. If you look at the business cycle here, I think yeah, Eurozone is something that we kind of don't understand at this point of time. So yeah, so that's where we're not even looking at. Given in terms of the sector views, we continue to remain bullish on the Indian foundation story. So infra, energy, metals, public banks, consumption themes, we continue to remain overweight on those, the sectors that we kind of discussed. We continue to remain, while we were massively underweight IT, last month we went ahead and started looking at IT. We still haven't found any decent name out there, or we don't have conviction on a name at this point of time. So we continue to put our research out there. Private banks, we think, are fairly priced. While the financial theme is turning, we are bullish on the financials of India, given that the credit cycle is also on the upswing. We think public banks are fairly priced. They can have a meaningful run-up, but given that valuations are not in favor of private banks, we're not looking at them as such. And in auto, we are very selective. We're not looking at things that were exporting much. We're looking at themes which are kind of looking into India. So again, autos, that's there. Debt, while debt is in a cycle that is favorable for it, we continue to remain neutral because there is a massive opportunity. We feel that in the equity. So to be overweight equity, we'll have to take out money from somewhere, and that's coming from debt. While if somebody is in debt, I think it is a decent time to be in debt, at least for the next, till the time that RBI has the room to cut rates. So till the time that we can cut rates, I think one can remain into debt. However, RBI cutting rates does not mean that debt does well. We've seen that across in the second half of 2025, while RBI had cut around 50 to 75 basis points, yields in India have gone up. Yields across the world have started to become very stable in terms of after the drop off, they become very stable. That tells us something. Remember the specialty chemical ones. After a drop off, it becomes stable. Then there is a meaningful chance that yields might start popping up again. If yields start popping up again, we would know where we are headed into. So given that scenario, it's safe to assume for us, or it's a very safe or easy choice for us to move into equity away from debt. The risk that we are watching right now, obviously we've told you, we're looking at labor market crash. That's a medium probability, but the impact is very high. The minute the labor market kind of crashes, the unemployment rate kind of pushes your SAM rule over 5, the economy is in a recession. So that impact is very high. There's a medium chance of that happening, around 25%. Indian valuations can compress, so that's there. China stimulus, PWOC starts, stops providing you liquidity. There's a very high chance of doing that, given that their balance sheet is kind of very stretched. So there is a very high chance. But given that they're not that there have been cases when they have done that, the impact what we feel is medium in a way. There's a very high impact of a second inflation wave. So if inflation were to meaningfully come back, then that curbs the ammunition that Fed happens. A market that is running on rate cut hopes, they lose steam. And if there is a global recession, the possibility at least in the first half, it's kind of low. It's still at 15%, but the impact will be very high. So if there is a global recession, we should be very aware about it. There are a few outlier risks that we kind of think about, and that is how we position ourselves. We think there is an outlier risk of a cyber attack. We think there is an outlier risk of energy being disrupted across the world. And given that 2026 is the year of midterm elections, I don't think a government would want to move into the midterm elections on the back of a recessionary environment. So that could lead to a unrest across the world. So given these are the outlier risks that we kind of look at, we can't place for them. We don't know for sure. We can't know when a cyber attack can happen. How we can place ourselves is basically be long on a particular sector that supports, or that's the thesis behind that particular thing. So how can we place ourselves by for risks like civil rights? We don't know if they'll happen in the next 15 days, or will they ever happen or not. But we can be underweight US in that sense and avoid that risk as such. So that's how we kind of look at outlier risk as well. There are a few portfolio construction principles that we do. We look at quality filters, we look at concentration filters, and there is a rebalancing discipline. So everything's systematic in a way. We're not taking based ideas. What we've done is we're not taking emotional decisions. We're taking very systematic framework-based decisions, and that's how we kind of work. So that's there, and I think I'm done here. I know it was quite a fair large session, but thank you for your time. Happy to take any questions. Thank you, Archibald, for the clap out. I think. Okay, I think they will sort a question. If the credit cycle is going to accelerate going forward, why are we still neutral on private banks? Because we think they are very fairly valued. There is a major opportunity in the public sector banks, which are undervalued at this point of time. So that gives us a lot more kind of room to run. So the choice between private and we're not underweight a private bank. We're neutral still. So valuation wise, you can only meaningfully put money into the financial sector. You can't put all your money into financial sectors. If we have a choice between private sector banks and public sector banks, we are choosing public sector banks. Our public sector banks choices have also, as I said, that the public sector allocation has delivered 38% return over the last year, when your Nifty bank was 21%. 21% last year was a very decent return. If you were in the banking sector, you got quite a decent return. If you were in private bank, possibly you still made decent returns, but the money was there in public sector banks. So that's why public sector bank. Given your second question, that public sector banks have already had a run up against private banks, doesn't that make private banks more attractive? Technically, it does. Technically, you would always want to say that public sector banks have gone up, so why not look at private sector banks which have not gone up? But valuation wise, how to say this? Okay, valuation wise, at the beginning of the cycle, your your private sector banks were overvalued and your public sector banks were undervalued. So that has made it a clear choice of going into public sector banks rather than private sector banks. Now public sector banks are fairly valued, but we still feel that private sector banks are fairly valued, but we still feel that public sector banks are undervalued. So that is why we're still continuing with public sector banks, because the valuation is making much more sense. If you looked at India as a cycle, across the cycle, public sector banks have never been so clean in terms of balance sheet, and they've never been so clean in terms of NPAs and all. So the loan growth is coming back in public sector banks. The balance sheets look clean. Valuation wise, they are attractive. Just because they have had a run up, we've been a part of it. Just because they have had a run up, I don't think we should exit them. As the run up can last far longer than we can think of.
Yeah, okay. Thank you, Karan, for answering my question. And this was a very informative session. Just wanted to add a question on top of it.
Sure.
So there was a news that the finance minister is planning to consolidate 12 PSU banks to 4 PSU bank. So
Yep.
matlab, does that change our stance, or matlab, how are we looking into it?
There are a few drivers they will inherit in terms of when you look at the banking sector. One is obviously consolidation. If you look at the consolidation segment, the consolidation has taken place before as well in 2019. The number of banks that got consolidated into one single bank, the ones that get consolidated into a larger entity, obviously they go through a major change of kind of the systems have to bring together. They have to kind of align everything together. So that's the change that is there. But there's another change that markets are bringing in, which is in terms of banking index. So banking index, what we've realized is that private sector banks are a major hold a major weight in the banking index, while public sector banks are quite underrepresented in your Nifty Bank index. So there is a rejig that is happening in the banking sector, wherein the index provider has said that banks, a particular bank cannot have more than 10%. So if that is the case, we feel that meaningful money can come out from the banks that have more than 10%. There are two private banks, larger ones, which have more than 10%. I think money can come out from there when that rejig happens. So there are two forces here that are, and those money have to then go into banks which are third, fourth, and fifth. And if you actually look at third, fourth, and fifth, there are two public sector banks out there. So I think money can move into public sector banks as well. So there are two forces here that are kind of driving the force. So one is obviously consolidation. I don't know when consolidation will take place. The second is basically the rejig of the banking sector as well. So given that the information that we've got in terms of valuation right now, the fact that the ratio that we've got is valuation, we continue to be overweight PSU banks.
Understood. Thanks a lot.
Omkar, go ahead.
Yes, sir. One question from my side. So since we're on topic of PSU versus private banks, right?
Yeah.
So if you see majority private banks, we have PE ratio of around 18-20 odd.
Yeah.
And for major PSU banks, anywhere between 10 to 12x, right?
Sure.
So since this re-rating is happening for PSU, do you see, how long do you see these valuations stretching for PSU banks from here on?
Thank you, Omkar, for that question. First and foremost, when we look at banks, we don't look at the PE ratio to begin with for valuation perspective. So earning for us hardly matters in terms of when we look in, it does not hardly matter, it matters to us. But the major thing for valuation that we look at when we look at banks is basically how big it is in terms of book value. So when you look at sectorial banks, you have to see three things here. One is basically growth. The second is what's the big book value and how are you priced versus the book value. And the third thing is basically how good a quality of a bank or how well they are managing their money. What is their NPA ratios and all of that. So there are three things that kind of do it. If you just want to look at it from a PE perspective, I think given that loan growths are higher in public sector banks than private sector banks, if loans are growing at around 12-13% in public sector banks and in private sector banks, if they're growing at 9-10%, then they should deserve the and given that they have clean books, they could end up getting valuation very similar to private banks. Obviously, how and when this will kind of converge, we have no idea around it. We continue to look at it from a data to data perspective. But in terms of valuations, I think there is major re-rating that is happening in public sector banks.
Right. Thank you.
No worries. Thank you so much. Thank you everyone for your time. I think this was a fairly long session, but it was required. At least it sets the tone that how we are gonna go for in 2026, what we believe in, what are the risks. We covered a lot of ground today in terms of what is the growth expectation, what is the risk that we are looking at, and how we are placing our portfolios, and which are the sectors that we are looking into. The team here at LLama Research is always available for you, and in terms of any questions that you have, we continue to look forward for interacting and having your support. I think yeah. So thank you again very much, and have a great year ahead, and we'll talk soon. Thank you so much.